The number on your screen is $847 million, but it is not your money. It is never your money. It is inventory. It is velocity. It is obligation disguised as opportunity. You are 23 years old, seated on the 31st floor of a glass tower in Midtown Manhattan, where the coffee is cold, the air is overfiltered, and your presence has already been translated into the only language this structure respects: function. Not person, not mind, not future. Function. You think you are entering finance. You are not. You are entering an architecture of leverage. The salary is the lure. The bonus is the anesthetic. The title is the visible costume placed over an invisible system designed to convert attention, stamina, discretion, and moral flexibility into usable output. You are not being asked who you are. You are being tested for what can be extracted from you without friction. Most people misunderstand power because they keep looking at money as if money were the objective. Money is not the objective. Money is the receipt. The objective is position inside the machine, access to information before language stabilizes around it, access to decisions before they are announced, access to consequence before it is distributed downward to people who still think the world runs on merit or law or sincerity. So today, we are not discussing careers. We are performing an audit. We are tracing the 7 layers of financial power from the junior analyst who still believes hard work explains advancement, all the way to the private architect whose name is absent from the cap table, absent from the headlines, absent from the record, and therefore present in the only place that matters: control. Level 1 is the function. Here is the first layer of initiation. You arrive with grades, internships, and the stale self-respect of someone who still thinks competence will be recognized as a virtue. Then the floor opens and the hours begin. 14-hour days on paper, 18-hour days in practice. Sunday becoming Monday without ceremony. You stop measuring time in mornings and nights. You measure it in versions of the deck. The body remains in the chair while the self slowly evacuates through the eyes. At this level, you are told you are learning. That is partially true. You are learning that exhaustion is not an accident of the system. It is a calibration tool. Fatigue strips away unnecessary identity. It makes you easier to standardize, easier to command, easier to compare. A tired analyst does not ask philosophical questions. A tired analyst asks whether page 42 should mirror the language on page 12. A tired analyst does not resist abstraction. He becomes abstract. This is also where you discover the first rule that no recruiting brochure prints. Discretion is rewarded more than honesty. Not lies, exactly. That would be too crude. What the machine prefers is selective fluency. To know what must be said, what must be softened, and what must disappear into formatting. You build a model at 2:11 a.m. There is a circularity issue buried in a debt schedule. The outputs are wrong. The valuation shifts by $2 million. Not enough to collapse the transaction. More than enough to expose your error. You find it before the managing director sees it. You fix it silently. The book goes out. Nobody commends you. Nobody asks what happened. Nobody says thank you for preserving the integrity of the analysis, because integrity is not what was preserved. The deck was preserved. The process was preserved. The illusion that the machine is seamless was preserved. That is when the understanding begins. The system does not reward the person who made the correction. It rewards the absence of disturbance. The highest compliment available to you at level 1 is not brilliance. It is that no one had to deal with your mistake publicly. So you learn to disappear inside output. You learn that your suffering is only legible when it interferes with execution. You learn that being right too loudly can be more dangerous than being wrong quietly. You learn to take a call while eating, to apologize for sleeping, to speak in summaries, to defer instinct, to experience the first thinning of the categories that governed civilian life. Happy, unhappy, excited, burned out. These become imprecise. What replaces them is orientation. Is the environment favorable or unfavorable? Are you protected or exposed? Are you moving closer to the center or being sorted toward the edge? This is level 1. The function is not yet powerful, but the function is being conditioned to find power beautiful. Level 2 is proximity to power. Now the title changes. Associate. The word sounds like progress because it implies inclusion. In reality, it means you are close enough to capital to observe how decisions are made, but not close enough to pretend your conscience still sits outside the room. Proximity to capital means proximity to decisions you would rather not have made. That is the trade. The analyst is still consumed by tasks. The associate begins to understand sequence. Not just how to build the materials, but why those materials exist, who is meant to be convinced, what fear is being managed, what timeline is artificial, what pressure is strategic. At this layer, preparation becomes the only currency that never devalues. Charisma helps. Intelligence helps. But in a room with a chief financial officer who has survived recessions, activist letters, refinancing cliffs, and internal politics you cannot see, only preparation converts anxiety into authority. This is where you first hear phrases like mezzanine financing, spoken not as textbook terminology, but as a practical instrument of control. Not enough senior debt available. Equity sponsor wants to preserve upside. The company needs flexibility, but not too much flexibility. The structure is built in the middle layer, expensive enough to hurt, useful enough to proceed. You present it with clean language. Hybrid capital. Structured solution. Tailored package. What it really means is that everybody in the room is negotiating over who gets to be protected first when the story fails to match the spreadsheet. You sit across from a CFO for the first time. Your tie is correct. Your materials are perfect. Your notes are over-prepared because over-preparation is the only shield you trust. The CFO asks one off-script question about covenant headroom under a downside case you did not expect. You answer because you have already lived inside the model for 6 days. In that moment, you feel the narcotic effect of competence in high finance. Not pride, not joy. Something colder. A recognition that if you can make yourself useful at the edge of consequential decisions, the room will tolerate your existence. But watch carefully what else happens here. Your access rises, and with it, your silence deepens. You begin to see that the people above you are not always more ethical, more informed, or more disciplined than the people below you. They are simply more fluent in ambiguity. They know that every decision memo is partly an argument about future blame allocation. They know that optionality for one party is risk transfer to another. They know that the words balanced outcome often mean asymmetry accepted by the weaker side because the clock forced compliance. At level 2, you still think power is visible. You still think it belongs to the person speaking. That misunderstanding will not survive. Level 3 is the dealer. This is the first major mutation. As vice president, the metric changes. No one cares how many hours you worked if the pipeline is empty. Labor stops being the story. Deal flow becomes the story. Volume, continuity, conversion. Can opportunities be sourced, advanced, defended, and closed? Can the machine be fed? The analyst sold time. The associate sold readiness. The vice president sells momentum. This is also where moral language is professionally retired. Not publicly. Internally, quietly, efficiently. You are introduced to what I call ethical architecture, the design of transactions whose technical legality is used to anesthetize their human meaning. You are not stealing. You are restructuring. You are not diminishing security. You are optimizing return. You are not exposing pensioners. You are rebalancing obligations to meet an IRR threshold. And one day, you are in the room for exactly that. A pension restructuring designed to satisfy a target return that the model can defend and the committee can approve. You know what it means for retirees. Not in theory. Precisely. You can see the distributional effect. You know which assumptions create the spreadsheet elegance. You know whose future becomes thinner, so that the transaction can be categorized as successful. And you say nothing, because at level 3, you learn the rule that separates participants from believers. Stop asking if the deal is good. Ask if it is executable. That is the rule. Cold, clean, transferable across sectors and geographies. Is it executable? Can lenders be aligned? Can counsel be managed? Can the sponsor be kept inside the timeline? Can the negative press, if it comes, be delayed until after economic control is secured? Can the pension hit the return threshold? Can the committee sign? Can the rating agencies be persuaded or ignored? Can the story survive contact with disclosure? This is the level where many people believe they become adults. What actually happens is more specific. They become operationally split. One self maintains a residual vocabulary of ethics for private use, usually late at night, usually after the deal is already impossible to reverse. The other self handles execution. Over time, execution wins because execution gets rewarded. The machine does not need you to become evil. That would require too much drama. It only needs you to become procedural. And here is the important distinction. The vice president is still not sovereign. He is a dealer, not an owner of the table. He coordinates appetite. He interprets pressure. He keeps motion alive. He is rewarded for making complexity travel smoothly from one institution to another. That is why he often mistakes centrality for control. He thinks he matters because he is always in the call. But being indispensable to a process is not the same as owning the outcome. Level 4 is relationship leverage. Now we arrive at director, managing director, the layer where most outsiders assume the game has been won. The compensation is obscene by normal standards. The floor opens more easily. People return calls faster. Calendars bend. Restaurants appear. But the real event at this level is not prestige. It is inversion. The inversion point is when your accumulated assets begin to change the economics of your own time. Let us say the number is $2.5 million in liquid and near-liquid assets. Not enough to own the world. More than enough to notice that spending 3 hours chasing a marginal task is irrational when the same 3 hours can preserve, compound, or redirect a much larger field of outcomes. At that point, your labor value and your capital value stop moving in sync. Your time becomes an inefficient use of resources unless it is attached to leverage. This changes everything. You stop optimizing for salary and start optimizing for access. You stop asking, "What can I do?" and start asking, "What can be caused through me?" Relationships shift too. The old categories fail here. Friendship, mentorship, collegiality. These words remain in circulation because polite society requires upholstery. But underneath, the architecture is clearer. Relationships at this level are leverage structures. Some grant information. Some grant distribution. Some grant insulation. Some grant introductions that remove 10 years of ordinary waiting. Some exist to ensure that if something fractures, you are not the first body under the falling material. This is why high-level dinners feel so intimate to people who do not understand them. They mistake composure for warmth. They mistake repeated contact for trust. They mistake remembered details for affection. But relationship leverage is not built on emotional reciprocity. It is built on repeated usefulness under conditions of discretion. Can you keep confidence? Can you connect capital to scarcity? Can you absorb complexity without broadcasting it? Can you solve a problem without creating visible residue? At level 4, you begin to see why public performance becomes dangerous. Visibility attracts amateurs, regulators, journalists, competitors, and fools. The people who rise highest in formal institutions often begin learning how not to look rich, how not to sound absolute, how not to become symbolically available to attack. Which brings us to the first warning. Nicolas Fouquet understood power, then misunderstood one fatal thing about proximity to sovereign power. He believed visible magnificence could coexist with an insecure patron above him. He staged splendor. He displayed capability. He made wealth theatrical in the presence of a king who could not tolerate a subordinate glowing too brightly. The lesson is primitive and permanent. At high levels, wealth may exist, but it cannot become a challenge. Flaunting assets is not confidence. It is bad systems design. If someone more powerful concludes that your display reduces their relative stature, you have already converted success into vulnerability. Remember that. Power hates mirrors. Level 5 is the system thinker. This is the passage from advising capital to deploying it. Private equity, capital allocation, direct control, no longer standing beside the buyer, becoming the buyer, no longer preparing options for the room, becoming the room that decides. The first psychological break here is severe. When you advise, there is still distance between recommendation and consequence. When you deploy, that membrane tears. Every thesis must survive contact with payroll, with debt service, with operational slack, with human beings whose names you will never learn, but whose lives will absorb your assumptions. This is where language becomes insulation. Board calls begin. Performance reviews. Portfolio reviews. Debt packages. Integration updates. And in these calls, the violence is almost never spoken in violent terms. It is translated into phrases designed to preserve emotional sterility. Right sizing, operational leverage, margin enhancement, synergy realization, footprint rationalization, overlap reduction. Then the number comes through. 800 layoffs. No one says 800 families reorganized by force. No one says 800 thresholds of fear activated in kitchen conversations, pharmacy visits, rent payments, custody arrangements, visa renewals, tuition deadlines. They say right sizing. They say operational leverage. They say necessary efficiencies to support long-term value creation. This is not accidental language. It is engineered distance. The system thinker learns that if consequences are described in sufficiently abstract terms, the mind can remain mechanically effective while the human cost is carried elsewhere by people with less insulation. At this level, you also learn that most organizations are not run on truth. They are run on timing. Say the correct truth too early and it sounds alarmist. Say it too late and it sounds self-protective. The highest paid people in the room are often those who can sequence unpleasant reality so that it becomes digestible just after it becomes inevitable. This is also where the machine becomes harder to leave. Because now the compensation is not just income, it is accumulation, carry, equity, co-investment, side pockets of upside. The architecture begins paying you like an owner, while reminding you that true ownership is still somewhere above you, distributed through entities you cannot fully see. And if you are intelligent, something cold dawns on you. You are no longer helping companies. You are redesigning them for extractive efficiency under a return mandate. Sometimes the redesign produces genuine value. Often it produces temporary improvement accompanied by delayed fragility. But the scorecard does not measure moral residue. It measures realized return. Level 6 is foresight. The sixth layer is where the frame itself changes. This is no longer company by company, deal by deal, manager by manager. This is macro architecture, sovereign debt, currency regimes, central bank behavior, duration, yield control, cross-border capital reflexes. You are no longer studying firms inside the market. You are studying the conditions under which markets become obedient to policy, panic, or scarcity. At this level, the ego mutation is dangerous because it contains a kernel of truth. You spend enough time modeling policy transmission, capital flight, basis dislocations, reserve behavior, rate differentials, and institutional reflexes that a strange sensation develops. You are no longer in the market. The market is in you. By that I mean your nervous system becomes indexed to systems most people cannot perceive. A central bank speech changes your pulse before the headlines summarize it. A bond auction failure feels physical. A currency intervention reads like posture, not event. You cease reacting to price as information and begin interpreting price as symptom. Take the Japan yield curve thesis. For years, outsiders could describe it in simple terms and still miss the point. They saw rates, bonds, central bank accommodation. But the architect sees a larger geometry. Suppressed yields, altering domestic allocation, currency pressure, exporting consequences. global funding conditions responding to the persistence of policy distortion, volatility waiting in a corner that polite commentary calls manageable right until it is not. You stop thinking in trades and start thinking in regime exposure. If yield control bends here, what unwinds there? If the currency weakens further, who is forced to rebalance? If a policy defense breaks, which hidden assumptions in other portfolios lose their camouflage? Foresight is not prophecy. It is disciplined anticipation built from exposure to patterns before they become narratives for the public. But it has a side effect. Once your mind is calibrated to systemic risk, ordinary life becomes unreadable in civilian terms. People ask whether you are happy. The question sounds malformed. Happy compared to what scenario? Over what duration? Under what volatility assumptions? Happiness disappears as a governing category. So does unhappiness. What remains is positioning. How much risk is endogenous? How much can be transferred? How much can be hidden? How much can be insured? How much can be survived if correlation snaps at the wrong moment? This is why people at level 6 often seem emotionally absent. They are not absent. They are over-oriented. Every room is scanned for fragility. Every opportunity is tested for convexity. Every relationship is assessed for informational asymmetry. They do not live in moments. They live in scenarios. Level 7 is the architect. And here we reach the layer most people never see, because by the time real power matures, it has already learned to remove itself from the obvious map. No title is required now. In fact, titles become inefficient. Titles create discoverability. Discoverability creates vulnerability. The final level is private. Not private as in secretive personality. Private as in structurally insulated. The trust owns the holding company. The holding company controls the management entity. The operating assets are segmented through special purpose vehicles in 9 jurisdictions, not because complexity is aesthetically pleasing, but because jurisdiction is defense, tax geometry, confidentiality, and contingency planning encoded into legal form. The signatures are delegated. The beneficial logic is layered. The disclosures are technically compliant and strategically unhelpful. The non-disclosure agreements survive litigation because the real objective of the document was never mere silence. It was endurance. This is where the machine reveals itself fully. The architect does not need applause because applause creates pattern. The architect does not need office status because location creates trace. The architect does not even need ownership in the simplistic retail sense. Control can sit upstream of optics. Influence can sit inside governance without sitting inside narrative. At level 7, privacy is the ultimate currency because privacy preserves optionality. If people cannot map you, they cannot coordinate against you. If institutions cannot fully situate you, they struggle to constrain you. If the public cannot name you, it cannot metabolize you into scandal. And by now, the final psychological transformation is complete. The categories are gone: happy, unhappy, successful, unsatisfied. These are words for people whose lives are still arranged around identity. The architect lives around exposure. Positioning against risk, preserving lineages of capital, hardening structure, managing counterparties, avoiding concentration of visibility. The self is not expressed. It is shielded. Now the second warning, Robert Morris is the necessary counterexample because he represents a mistake common to capable men who survive the early thresholds and begin to confuse prior success with structural invulnerability. He crossed into influence, into scale, into the confidence that comes when systems keep validating your judgment. And then leverage became appetite. Appetite became overreach. Overreach met reality. This is the second trap of high power, believing that because you understand the machine, you are exempt from its mathematics. You are not. Crossing the inversion point does not make you immortal. It only changes the unit of your mistakes. At low levels, error costs sleep. At high levels, error costs structure. Liquidity mismatches do not care how often you were right before. Funding pressure does not respect reputation. A man who has been correct for 10 years can still be destroyed by a timing mismatch inside 1 year if confidence outruns cash and commitments outrun flexibility. So take the two warnings together. Fouquet teaches, do not display power so brightly that you trigger superior force. Morris teaches, do not internalize power so completely that you stop respecting constraint. One died politically because his magnificence became visible challenge. The other collapsed financially because success altered his tolerance for risk faster than reality, altered its tolerance for him. That is the audit. And here is the conclusion most people resist. The machine does not primarily sort people by intelligence. Intelligence is common enough. It does not sort people by morality either, because morality is too unstable under incentive pressure. It sorts by tolerance for abstraction, by capacity for discretion, by endurance under asymmetrical stress, and by willingness to convert human consequence into administrative language without breaking rhythm. At the bottom, you are a function. In the middle, you become an instrument. Higher up, you become a node through which leverage travels. At the top, if you make it that far and avoid both vanity and overconfidence, you disappear into architecture. That is why the salary was never the point. That is why the bonus never satisfies for more than a weekend. That is why the title keeps evaporating the moment you receive it. You were not climbing toward wealth. You were being acclimated to a worldview in which people, companies, governments, even futures, can be reorganized into components of a larger mechanism whose first commandment is preservation of control. And if this sounds cold, it should. Warmth is what the brochures sell to recruits before the first all-nighter. Warmth is what institutions perform in panel discussions and alumni dinners. Warmth is the aesthetic wrapper. But the architecture underneath is precise, unsentimental, and designed to continue operating regardless of who burns out inside it. So, if you are 23, on the 31st floor, staring at the glow of a model you no longer trust, understand what is actually happening. You are not merely earning. You are being oriented. Your speech is being cleaned of friction. Your conscience is being exposed to abstraction. Your body is being taught that fatigue is normal. Your ambition is being linked to access. Your access is being linked to silence. Your silence is being linked to advancement. And advancement, if uninterrupted, leads not to freedom in the childish sense, but to the ability to engineer outcomes from a place the public cannot see. Some of you will call this cynical. It is not cynical. Cynicism is lazy because it implies distance. This is not distance. This is inspection. Open the panel. Follow the wiring. Observe what gets rewarded. Observe what gets erased. Observe who can speak plainly and who must speak in cover language. Observe how human beings become cost inputs, how institutions become vehicles, how law becomes topography, how privacy becomes armor, and how the highest form of power is often the absence of a visible name. It was never about the money. It was the machine. Comment which level you are currently observing.